Welcome to the video version of the Pirls Stock Market Commentary for August 21st, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio rose to 1.97 from 1.87 last week, continuing in bullish territory. The total count of securities in bullish or bearish patterns increased fractionally to 3,186. The count of bearish stocks decreased 3%, while the count of stocks in bullish patterns increased 3%. The Pirls P&F Market Breadth Summary Chart shows us a market now 8 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 34 points for the 8th decline in 27 weeks. At a positive 554.20 points, it continues below the recently formed August 2016 top, and above all remaining 4 tops above plus 100, and also continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum, now fallen to a positive 72.21 from a positive 107.31 a week ago. The CCI 20 daily continues outside the plus or minus 50 range required for a valid zero-line reject long entry signal in a Woody's uptrend begun 5 weeks ago. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 16 weeks ago, while the daily CCI 20 began a Woody's uptrend 5 weeks ago. The CCI 20 weekly fell to a positive 156 from a positive 184.30 last week after forming a zero-line reject long entry signal for Monday, 7/11 open. We will continue to follow the results of this trade simulation in next week's commentary. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary, tech and oil on top, REITs and precious metals on the bottom. Bullish, computer hardware has left the bottom 5 and entered the top 5. Disk drives and semis have entered the top 5. Gold and silver has entered and leads the bottom 5. Oil services has left the top 5. Bearish, REITs continues in the bottom 5. Oil continues in the top 5. KBW Bank and Networkers have left the top 5. Focus this week from Dana Lyons of J. Lyons Fund Management, posted at www.zerohedge.com with an added note and additional charts. Investor complacency is smashing records. The following are some key points. Sentiment extremes can persist for an extended period of time before any negative consequences unfold. Indeed, the markets have continued to creep higher ever since, along with investors' optimism. At this point, however, sentiment is getting to the point where it is a legitimate red flag in our view. In fact, by one measure, the market has never witnessed a stretch of such investor complacency. The VIX is actually the 1-month S&P 500 volatility index. Meanwhile, the VXV is the 3-month volatility index. Typically, the VIX will be lower than the VXV, as there is less time in the near term for volatility rises to occur. When investors get especially nervous, usually during a sell-off, near-term volatility expectations can actually rise above those farther out. That is, the VIX/VXV ratio rises above 1. Conversely, during times of complacency, the VIX will drop to relatively low levels versus the VXV. Historically, under 0.8 may be considered complacent. At this point, complacency has extended beyond any historical precedent. Specifically, while just 14 days in the past 9 years prior to July had ever seen VIX/VXV readings below 0.78, this week saw the 21-day average, approximately 1 month, drop below that level. We are already in uncharted waters. The only time the 1-month average VIX/VXV dropped even below 0.8 was in March 2012. For what it's worth, the ratio remained below 0.8 for the next 11 days. Meanwhile, the S&P 500 gained a maximum of just 1% as it meandered sideways for the next 5 weeks before getting clipped for nearly 10% over the subsequent month. At the very least, we would recommend investors not get lulled to sleep by the present calm in the markets, especially considering the record short VIX and long Dow Nasdaq positioning among future speculators. Thank you for tuning in for this week's Santa Pirls Stock Market Commentary, featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you're looking forward to a profitable and productive week coming up, and wishing you, as always, true success and the wisdom to know when you've achieved it.